The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The market wants to rally, but Oracle trying to spoil the party. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. At least one big benchmark has found a way to rally. That is the S&P 500 just poking into the green. Of course, I can't say the same when it comes to the NASDAQ 100. Still dragged down by Oracle, which we'll get to in a moment. The NASDAQ 100 off by about 0.4%. The bond market pretty well behaved after the performance that we saw from Jerome Powell yesterday with that rate decision, pretty much unchanged again on the 10-year. And then Oracle, as I pointed out, down about 10% at the moment. That is acting as a big weight on the NASDAQ 100, still capping the enthusiasm that you're seeing on the S&P 500, but off its lows of the session, Romaine.
I'm glad, Katie, that you chose to put Oracle on that board because AI really has been the dominant trade for 3 years, and Oracle had been for some time a core pillar of that. Now, whether Oracle wedges itself back into the mix remains to be seen. A 10% drop now, but on an intraday basis, it was down as much as 17%. Not just the worst day since January, but if it were to get back to that level, that would be the worst single day post-earnings performance for the database company going all the way back to the 1990s. But I caution, don't extrapolate too much into the AI trade. Oracle, well, it's always been a bit of an outlier relative to the Microsofts and Alphabets of the world. Billions in negative cash flow on a 12-month rolling basis and a long-term debt load that is set to surpass $100 billion. Now, we may get a cleaner read on the AI trade with earnings tonight from Broadcom, a maker of custom chips for the AI infrastructure build-out, a build-out that some people look at and say it can still go with more than $500 billion in financial commitments out there.
I personally don't think we're in a bubble right now, and I think even on the AI front, the AI capex is a percentage of GDP based on, right now we're talking, when we say AI bubble right now, we're talking about infrastructure. I think if you look at the infrastructure spend, I think based on a percentage of GDP, based on the cash flow of the companies doing it, it's not, someday it will get overdone. It's not overdone yet.
Now, believe it or not, there's actually a lot more going on out there in the markets than just the AI and tech trade. There is a bid to the markets into materials like Newmont, which is at a record high, into financials like Chubb, which is at a record high, into healthcare stocks like Johnson & Johnson, which is at a record high. In fact, materials outperforming the S&P today by the most since July. Dow Industrials outperforming the most since January. And get this, the Russell 2000 just one more rally away from outperforming the S&P on an annual basis for the first time since 2020.
Certainly fascinating. It's going to be interesting to see if that dynamic holds as we get to the final weeks of 2025. But I wanted to refocus on the economic landscape here and specifically on the labor market. You're taking a look at jobless claims behind me. You have weekly initial jobless claims in white. You can see it's a very volatile line, but in the latest session, that is actually surging to a multi-month high there. Then you take a look at the 4-week average in blue. It's still more restrained here. It's ticking up a little bit with that most recent surge. And one of the reasons why it's important to keep an eye on this chart is that you think back to what we heard from Jerome Powell yesterday, Romaine, basically saying that we could be overestimating hiring when it comes to the labor market. And you think about the dual mandate that the Fed has, it seems like still the labor market side is perhaps the more urgent side of the equation right now.
All right, well, let's pose that question to our first guest as we kick you off to the close here on this Thursday afternoon. Russ Brownback joins us here in Studio 2, Deputy CIO of Global Fixed Income at Blackrock. Russ?
Hey, Romaine.
When you look at the economy, and more importantly, you look at what the Fed is trying to do, the labor market, does that take precedent?
So, look, we think that the inflation situation today, when you look at overall, the Fed's statutory mandate is price stability. That's been achieved. The volatility of inflation is all the way back down to where it was pre-pandemic. So sort of front and center in terms of the Fed's reaction function is the labor market. And there's a lot going on there. It's supply constrained owing to the change in immigration. The demographics, the aging of the population means the employment to population ratio is sort of trended down, and you got a productivity story happening. And so it's kind of a low velocity environment overall. Mm-hmm. We think the Fed's right to be focused on that part of their mandate.
With regards to productivity, we played a clip from Robert Kaplan, who was on a little bit earlier today, and in the broader part of that interview, he talked a lot about the potential improvements to productivity from AI and how this actually means that the AI build out to a certain extent is going to become a Fed discussion at meetings going forward.
Yeah, I was super heartened to hear to what degree they went, Chair Powell yesterday in the press conference, to really identifying this as an influence. And quite frankly, there's been a stealth productivity inflection higher after, a decade of dormancy ever since the pandemic. Necessity being the mother of invention, companies needing to sort of on their feet sort of find efficiencies across their supply chains and the like. So this has been a phenomenon. So when you think about 2% productivity growth, you can grow the economy at 2% without adding 1 minute to the hours worked. That's what's happening. And now productivity set to inflect even higher with generative AI.
I want to talk a little bit more about AI as it relates to the bond market. And when it comes to this basically debt deluge that we're seeing in terms of, a lot of these big borrowers tapping the bond market to fund their AI hopes and dreams with that build out. What has that meant for you as an investor? Because, you've seen a lot of big tech issuance in particular.
Yeah, it's very welcome. And so you think about, we've lived in a world in credit markets that are kind of starved of new issuance. So a couple of unbelievable statistics. The high yield market is the same size it was 5 years ago, has not changed at all. The investment grade market had a record amount of gross issuance this year, but the net issuance was less than 1% of that, which is outstanding. The Treasury market issued 10%. And so there's been this scarcity. So that surge of issuance, which, by the way, we're expecting to continue next year with a CapEx super cycle, we welcome that, particularly if it comes at a concession to the secondary market. So get out of the way of it, wait for it to come, and participate when it comes at the right price.
So an opportunity there. I want to seize on what you were saying about the high yield market, that it's not growing, that it's stayed flat. And you think about, the size of everything, it feels like it's inflated over the past couple of years. Why does high yield stand out? Why isn't it growing?
So, you've seen, as in a rising rate environment, the traditional structure of a high yield bond today and the way that call features priced in, there's more incentive for some of the lower rated borrowers to get more, to go into the floating rate market, into the loan market. So some of the lower quality borrowers have sort of transitioned into that market. And so that market has grown. But the overall high yield market in general, which is as high quality as it's ever been, also has this amazing technical to it, which supports stubbornness of tight spreads.
Well, with regards to those tight spreads, are you anticipating that we are going to see a meaningful widening of them anytime soon?
So, listen, we're so excited about the environment we're coming into. So spreads are tight, justifying those technicals, justifying overall systemically good credit quality. But you have this CapEx super cycle, meaning these waves of issuance can create tactical trading opportunities. We're expecting an M&A wave in the new year, which can cause a leveraging of companies, and there's opportunities on both sides of that trade. And there is a dispersion in the economy. So we do think defaults can marginally tick up into the new year. And so, again, being a stock picker or a credit picker is like nirvana for us.
And I do want to bring in private markets to this conversation, especially, you think about high yield staying flat in terms of size. I wonder how much, this uptick that we're seeing in private credit can explain some of that. But you think about the recent concerns that we've seen over the past few weeks, concerns about due diligence, whether it's being done properly. I wonder where you fall on that question.
So we live in a world where there's too much money, not enough yielding assets. And so you do have instances of marginal lenders making marginal loans to marginal borrowers. The answer is don't do that. The answer is have a very, very sophisticated lens. Make sure you know what your collateral is. Make sure you know how to negotiate covenants and where they're strong enough. There are plenty of very good opportunities. And so, again, it really plays to the strengths of those that have, the right lens to pick the right credits and avoid the ones that are the potential pitfalls.
Part of the reason, though, when we look at some of the issues that we had this year was that there are a lot of folks that aren't doing that due diligence. Now, some of that's just, different firms, different standards, but also there's this idea of competition for assets. And I am curious as to whether, how you sort of make sure that you avoid competing for something without having done the right due diligence.
Deep expertise, a lot of gray hair, having lived through many, many credit cycles and knowing what's possible. And of course, by definition, credit assets have that negatively convex sort of price in terms of, you might earn your coupon and you might get paid back par. But if you get in trouble, your downside could be significant. So just being very, very careful and never letting your guard down about where you allocate credit capital.
All right, well said, Russ. I have to leave it there. Russ Brownback, Deputy CIO of Global Fixed Income over at Blackrock, helping us kick you off to the close here on this Thursday afternoon with the big focus on the economy. We're going to go deep into that, particularly here in New York City with the new mayor set to be inaugurated in just a few weeks. We're going to catch up with Andrew Kimball, the president and CEO of the New York City Economic Development Corporation.
Then we'll get an economic read from the retail sector with Lululemon reporting results after the bell. Naveen, Jaggi, president of Retail Advisory Services over at JLL, here to give us a broader picture of the sector and what he's seeing with consumers.
And Katie Thomas is also going to stop by the program over at the Kearney Consumer Institute, and we're going to talk about why she's predicting conservative growth in retail sales for this holiday season. Some interesting discussions coming up in just a bit. Stick with us. This is The Close on Bloomberg.
The Fed deciding to cut rates in its final decision of 2025. As we look ahead to 2026, the FOMC is maintaining its projection of only one cut in 2026, also in 2027. Here to discuss this and more is Darius Dale. He is the founder and CEO of 42 Macro, a macro research firm. Great to see you in person, Darius. So you think about what we got yesterday. The expectation was that we were going to get a cut, perhaps a hawkish cut, but listening to the press conference, I'm not quite sure if that's what was delivered.
Well, thanks for having me. Appreciate you guys for being on. In our opinion, that might have been one of the most historic FOMC events in our lifetimes. This is a Federal Reserve that, in the midst of a nationwide affordability crisis, effectively said, we have to expand our balance sheet. And we have to give the repo market the liquidity that it needs for hedge fund leverage and retail margin debt to continue expanding. And so in my opinion, that represents a significant sea change in monetary policy in terms of the Fed's reaction function, a reaction function that we already thought was going to change anyway next year as a function of the next Fed year.
Well, talk to us a little bit more about that, because it's difficult messaging, right? They're buying Treasury bills, but it's really being cast as reserve management. But you still have the folks on social media and the like saying that, no, this is QE. Including yourself. Including
myself. I should have brought my bubble. My bubble blower. No, look, I mean, I'm being tongue-in-cheek about it, but what it does represent is it represents an erosion of central bank independence. Now, they're going to couch it as reserve management operations or whatever they want to couch it as, but the reality is the federal government's balance sheet and the growth of the federal government's balance sheet has grown, it's gotten too large, and so ultimately we need the Fed to take pressure off the system in order to, help sustain the bull markets and assets, sustain growth in the real economy. And ultimately, this, again, like I said, this is a very significant change in U.S. monetary policy.
It gets to this idea, though, as whether the market can ever stand on its own again. It's funny, before this show, I was having a conversation off camera with someone about the global financial crisis, the start of QE, QE2, QE Infinity, and, everything else in between. And it gets to this idea that the Fed does try to pull back from time to time, but it's never really found a way to permanently pull back. And I'm wondering if we ever get back to that.
It seems unlikely from this starting point. I think that we're probably multiple market and economic cycles away from having that, sort of come to Jesus moment with monetary policy. But between now and then, if you look about from a risk-taking perspective, from our perspective and the perspective of many of the top institutional investors on global Wall Street, there's really only 6 things that impact asset markets: growth, inflation, monetary policy, fiscal policy, liquidity, and positioning. Growth's already improving. Inflation is going down. It's a tailwind currently. We just saw the change in monetary policy. That's good. Fiscal policy's been tightening, but it's going to be easing significantly next year. The liquidity cycle is already still in an uptrend, and the Fed is adding more liquidity to the system. So the only one of the 5 cycles that's an issue right now is the positioning cycle. And we see historic degree of crowded bullish positioning, but we know the positioning cycle is not a catalyst. So when you have all that good news and all the other key macro cycles that matters, it suggests that the risk is that the markets could start to bubble.
It's interesting you say that, too, because we have seen a little bit of a rotation in U.S. public equity markets away from that high concentration in tech and AI, but that is still the dominant theme. And I am curious, because this came up in the press conference yesterday with Powell. It was brought up today in an interview on Bloomberg with Robert Kaplan, a former Fed governor. And it gets to this idea as to whether that AI trade and the AI build-out is now a macro economic story, and a story that would have to be dealt with to a certain degree by the Fed.
Yeah, well, the Fed's going to get dragged kicking and screaming to deal with it anyway. But our take on AI is this. We're going to, at the end of this rainbow, whatever it is, it's going to be a secular bear market in either the stock equity market or a secular bear market in society. And so right now, I think the starting point you need to recognize is that we are very much in the early innings of what could potentially be a bubble You don't want to be short that. You don't want to be fighting that. I know that investors look at valuations, but they're not factoring in all of these positive liquidity and monetary dynamics, the fiscal policy dynamics, as well as the free cash flow that the index currently generates relative to what it did back in the 90s.
Interesting. So you're saying, in your view, that bubble, which a lot of people would have an instinct to maybe lean away from or short, but in your view, it sounds like it's just going to expand from here.
When bubbles are inflating, you want to be long them. When bubbles are inflating, go buy them. It's pretty straightforward.
The problem is you're trying to time it so you don't get caught up in the burst.
Can I say something on that?
Yeah.
I don't believe in market timing whatsoever. We're trend followers at 42 Macro, quantitative investors.
Yeah.
I don't believe that you can sell the exact top of the market. I don't believe you can buy the exact bottom of the market. But what you can do is sell near the top and buy near the bottom with trend following processes like ours.
All right, well said. Darius, always great to have you. Darius Dale is the founder and CEO of 42 Macro. When we come back, we are going to talk a little bit more about that AI trade and the big downdraft today in Oracle. The earnings are out and the red flags are up. Stick with us. This is The Close on Bloomberg. All right, time now for our top calls. Big movers on the back of analyst recommendations, and we start with Roku. The shares higher after Jefferies upgraded to buy from hold. The price target going to $135. The analyst says watch this space as an ad partnership with Amazon. Political tailwinds and subscription momentum could boost 2026 revenue growth. The shares up 1% on the day. Next up, Boot Barn. Goldman upping their target or initiating coverage of the retailer and others and giving Boot Barn a buy rating and a price target of $225. That's the highest among their new slate of retail coverage. Those shares right now at a record high. And finally, GE Vernova. Seaport Global cutting the power equipment company to neutral. Shares are down on the back of that downgrade, along with the news of Oracle's earnings, sparking concerns over spending on AI, which of course has been a key driver of electricity demand. Those are some of our top calls there. So let's get right to it with Oracle. The focal point of a lot of the data center build out, disappointing investors yesterday, not so much with sales growth, but concerns as to, well, how you actually fund that growth. The company increasing its spending on AI data centers and other equipment. Let's discuss this with analyst Brian White, Global Head of Internet and Software Equity Research over at Monness, Crespi, Hardt. Great to have you here, Brian.
Yeah, hi.
All right, so let's start. I mean, we see the revenue, profitability wasn't bad, but you got this gigantic backlog. In general, that would be great, but you have a company that doesn't necessarily have the cash on hand to fund the delivery of that backlog. Is that concerning for you?
Yeah, I mean, this AI dream for Oracle is turning into an AI nightmare. That's what's happening. I mean, they're spending like there's no tomorrow. Debt is going to go up for years. Free cash flow is going to be negative for years. And investors aren't going to take it anymore. That's the bottom line.
Yeah.
So,
but I was taking a look at some of the free cash flow numbers. I mean, they're running negative now on a 12-month basis. I mean, they had a long history of positive free cash flow, a long history of relatively modest debt. I mean, I know they've been on the upper echelon, but nothing really outrageous. That debt load has doubled. I mean, they're like at something like $100 billion, and they're most likely going to go back to the market for more. Their negative cash flow tracking at $13 to $16 billion. I guess my question to you is, why is this a concern today and wasn't necessarily a concern 3 months ago when we had that big rally off the last earnings report?
it's a great point. I think you're in different cycles of AI.
Yeah.
And at first it was RPO, and everyone loved the RPO. You got that last quarter, it hit the all-time high in September. Now RPO means more CapEx, negative free cash flow, and more debt.
Yeah.
That's what it means. It doesn't matter what number you put up, no one likes it.
Yeah.
And and I also look at this, that RPO, any cloud in the industry could have won that business if they wanted to be sloppy with their financials.
I gotcha.
Okay?
Yeah.
This is not, this is not rocket science. Any company can do this.
Yeah.
They're training models. Any company can train models. At first, they were a little better and they had an advantage. Everyone can do the same thing now.
Yeah.
So,
but when you say everyone, I mean, who else is out there?
the big cloud vendors.
The big cloud vendors.
Yeah.
I got you. Okay.
Yeah. So Google, Amazon,
Okay.
they can all do it.
Gotcha.
Microsoft.
Well, I am curious about the ripple effects here because we got the numbers yesterday. You saw a negative reaction in Oracle. You initially saw a negative reaction when it comes to CoreWeave, when it comes to NVIDIA. CoreWeave just managing to go positive right now. But is this a specific Oracle story, or do you think that this has implications for the rest of the space as well?
I think Oracle is the one that's not being disciplined. Okay, all these AI stocks, if one has a bad day, right, everyone catches a cold and they want to blame the whole complex. But, Oracle's just not being disciplined. It's going to take, Larry Ellison needs to put on his black hat, come out and say, look, enough is enough. We're not taking these massive orders that's going to destroy our balance sheet. And I'll give you an example. So CapEx this year, $50 billion, fine. That CapEx to revenue is 75%. The 28-year average is 5%.
CapEx to revenue, wow.
Is 75%.
Wow.
Even if you go out all the hyperscalers and the web guys, the next highest is about half that.
Well, to that point, you think that Larry Ellison needs to come out here and say enough is enough. You pointed out in the notes you sent over to our producers that this was the first earnings call with the new guard. They have 2 new CEOs, a new CFO. What did you make of the performance on the call?
A shambolic call. It was a horrible, horrible call. They weren't even organized. The IR guy with the CFO, with the CEO, complete shambles, okay? And then I felt like they weren't answering questions directly, and they gave guidance last time, but they didn't give it this time. It was a disaster.
Is there any way to sort of right the ship? And not to suggest that there's a sinking ship just yet, but do you think there's a way that at least the co-CEOs can sort of sell this to the market? What can they do post-haste?
Rainan's, just don't take as much business. I mean, you don't need this. It's ridiculous. You have... you have to have an economic model that people respect.
Yeah.
They don't have it right now. I mean, I have debt going up from $108 billion to $168 billion by the end of fiscal 27.
Wow.
Right? And who knows? It probably continues to go up at this pace. Larry's got to come out and say enough is enough.
Okay.
This guy that's, Clay, who's co-CEO, is running that OCI infrastructure business. What are you doing, man? He's got to come out and say something.
All right.
And stop it. You don't need all this revenue. It's silly.
Brian, we are up against the clock. Unfortunately, we have to say goodbye. Great conversation. Stay in touch. That is Brian White. He is Global Head of Internet and Software Equity Research over at Monness, Crespi, Hardt. Now coming up, what's fueling New York City's widely watched economy as the city braces for a new mayor? We'll go straight to the source with Andrew Kimball. He is the president and CEO of the New York City Economic Development Corporation. That conversation coming up next. This is The Close on Bloomberg.
.30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld. We're keeping an eye on markets, also keeping an eye on Manhattan rents, Romaine, which, as I understand it, just hit another record high.
Yeah, I'd rather not look at them, by the way, here. But yeah, some new data out talking about, just how high the rents have gone. And it's kind of interesting, too. We keep talking about the K-shaped economy. When it comes to Manhattan rents, it's a bit K-shaped, too. Like most of the gains or the biggest increases are actually at the higher income levels or higher, rent levels and, the bigger apartments.
Well, you think about the median, the effect of that.
Yeah.
The median new lease signed was $4,750 in November. That is up 13% from a year earlier, 3.3% higher than October. That's according to data from appraiser Miller Samuel, as well as Douglas Elliman. And it's not just the median, it's actually the price, and the price per square foot also hit record highs in November.
I love when you throw numbers out like that, because right now there are 2 people watching this show. There's some New Yorker who's like, $4,700, that's not that bad. Then there's some person in middle America who's like, you guys are idiots for living in New York City. But anyway, it gets to the idea, just kind of the diaspora of this city, economically speaking, and of course a new mayor who's going to be inaugurated in a few weeks, who of course campaigned on the issue of housing affordability. Joining us right now to talk about the economic conditions in the city is Andrew Kimball. He's the president and CEO of the New York City Economic Development Corporation. Great to see you again, Andrew.
Great to be here.
Let's start off with housing first, because obviously Zohran Mamdani made that a key pillar of his campaign. And I am curious that when you start to talk with business leaders and other folks who are going to have to some degree or another, work with this administration, are we all on the same page with regards to what needs to be done when it comes to addressing housing affordability?
I think we're getting there. I think that the mayor-elect was brilliant in focusing on this issue in the campaign. It's clearly something that hit home. we also a victim of our success. So EDC just came out with a report on the state of our economy, and there's a lot to like in there, with an all-time record for jobs, for workforce participation, people either employed or looking for work, at an all-time high for tax revenues. At the same time, we are competing very strongly against our competitor cities. We're gaining more population, particularly young people, 565,000 people, and young people, recent graduates, in the last 3 years. Our commercial leasing market is red hot, far beyond any of our competitor cities. So we are well positioned, and the cost of housing, right, is a factor of that. It's a factor of demand and supply, and we are not building enough supply. And I think that what you see is business leaders coming around to the fact that this issue of affordability is an issue of economic development and strengthening our economy, and we've just got to build more and make this city more affordable.
There's two aspects to this, and I just want to touch on something you said about younger people coming in, because it's one thing to attract people to the city, but something that has plagued New York City for quite some time, certainly prior to the pandemic, was you get a lot of young people who come here to start their careers, but once they start having families and other sort of obligations, because of the affordability issues, they fan out to New Jersey or Westchester, or maybe leave the region altogether. Do you think some of the policies, and more importantly, some of the work that you're going to do, is going to actually help people stay here, make this their home long term?
Absolutely, and we don't sugarcoat the challenges in our State of the Economy report, right? We are, along with everybody else, suffering from some uncertainty in the national economy, tariffs, interest rates, federal cuts, and affordability issues associated with that. And at the local level, the point you are hitting on is the exact right one. So whether you're a working class New Yorker and have lived here your whole life, once you start to have a family, you are getting priced out at way too high numbers. If you're one of those young people who moves here for a job in tech or AI or life sciences, typically you're here 8 to 10 years and you start to have kids, you're moving out. Where are they going? They're overwhelmingly going to the suburbs. We need to make sure we're not losing those folks. That's a real economic development, economic policy issue for the city. And the key to that is building more supply.
Do you hear that, Katie Garfield? Okay. She left. She's a former New Yorker.
I moved across the river. I'm in Hoboken.
We want to bring you back.
It's the same story. I mean, people, have maybe 2 kids in Hoboken, and then they have to move to the proper suburbs to actually buy something that could support 3 or more. But I'm taking a look at your report, and this line caught my eye, that downside risks have emerged that could impact New York City's ability to attract population, talent, business, investment, and tourism. Talk us through some of the biggest risks there that could potentially impact those.
Yeah, I mean, I think at a certain point, and I think this is why business leaders are aligned, not only with the current administration, but the incoming administration, that if we don't build the housing supply at a certain point, it's going to hit a point, even though all the young people want to be here because the jobs are here, they love the quality of life, they love the diversity of New York, but it's just going to become too expensive, and we're going to start to lose those young people to other commercial centers. That's a real issue for corporate New York. So we need to be laser focused on that. Look, I think there are clear concerns about federal cuts, NIH, NSF. One of the anchors of our economy are eds and meds, and we generate generally more research dollars and then try to commercialize that into businesses here than many other cities. And that is a real storm cloud on the horizon. I think tariffs as well, immigration as well. And you have seen a little bit of a slowdown in tourism, particularly from Canada and Mexico. We've seen that. Look, even though what you see on the streets of New York is unlike what you see on any other major metropolitan city in the country and really in the globe. The dynamism, people still coming here for the shows, our hotel occupancy rate is incredibly high.
Yeah, it was the tourism bit that caught my eye in particular, because we're having this conversation on December 11th, and Christmas in New York City is certainly a special time. And I say that as someone who will die in New Jersey. But what are you seeing when it comes to domestic tourism? You talk about, maybe those numbers coming down from Canada and Mexico, but when it comes to folks, visiting from other parts of the country, do you have that data?
Yeah, those numbers are strong, and it's not just the rest of the country. I mean, remember, we live in the largest metro area anywhere. It's one of the largest economies in the world on its own when you count our suburbs, even the one you live in. And so there's enormous inbound for the shows on Broadway, for our cultural institutions. That is a key part of tourism for New York, and that remains strong.
I am curious. I mean, how is kind of the retail sector holding up? And more importantly, like the restaurant sector, because I've heard a lot of anecdotes, not actual data, but anecdotes, that we are seeing maybe a little bit of struggles there. And I'm not sure what that's attributed to, whether it's just simply people not going out or maybe people going out and spending less. Do you have any evidence here?
We are light years from where we were 3 or 4 years ago. Remember, down 1 million jobs, people wondering whether people were going to ever come back to the offices. We now have the highest rate of return to office of any city in the country. That's not only important for the financial viability of those office buildings, but for all those small businesses, the restaurants. Those numbers are solid, right?
Yeah.
Small businesses are being created at a very fast clip in New York City. That is the backbone of our economy, even though we think of ourselves as a big corporate town. It's really the small businesses. I think retail in general is going through a metamorphosis. Last mile has changed so much. 80% of New Yorkers get a package every week at their home. You couldn't have imagined that 10 years ago. Experiential retail, though, is really changing it. And it's not just the tourists, it's not just going to the shows, but it's going to an experience where you're interacting and you also have the opportunity to shop.
Yeah, it reminds me of my niece came to town and she wanted to go to the Ralph Lauren store. Not for the clothes, but for a cup of coffee and some other pastry.
What's it called? I like their coffee shop that they have.
I don't know. All I know is she had me buy her a baseball cap that was $60. But
well, that was
there you
generous
go.
of you.
You didn't need to know all that, but there you have it, Andrew. By the way, tell all those people who keep threatening to leave New York once Iran gets, and tell them to stop talking. Just please.
Are they still making those threats?
I think they're quieter now.
Might be
the numbers tell it all,
Yeah.
and the economy is strong. But I'll just point out one other thing about the incoming mayor that's an economic issue that he has rightly highlighted, which is childcare. And that is a key factor, along with housing, childcare, energy costs, are all hitting every New Yorker, whether you're low income, middle income. And we've got to do something about it. And you've heard the mayor and the governor talk positively about this. Again, for corporate New York, this is really important. Those workers who they want to stay here need to have childcare. We need to have everybody in the workforce.
Absolutely. Andrew, great to get some time with you. Really appreciate your perspective. That is Andrew Kimball. He is the president and CEO of the New York City Economic Development Corporation. Now, coming up, from a whole new world to a whole new algorithm, Disney investing $1 billion in OpenAI and shares taking flight on the news. It's today's Stock of the Hour. Up next, this is The Close. The House of Mouse is going all in on AI. Disney will invest $1 billion in OpenAI and license its iconic characters, you know them well, Mickey Mouse, Stitch, and Cinderella, to Sora, which is OpenAI's video platform. The deal makes Disney a major customer of OpenAI. Mandeep Singh, he is Global Head of Technology Research over at Bloomberg Intelligence. He joins us now. So Mandeep, this is a pretty big deal. This is the largest equity investment that a major Hollywood studio has taken in an AI model developer. Just to set the scene, what's your reaction? Who does this make the most sense for?
I mean, it makes more sense for Disney because all these LLM models, the way they are trained, they use everything that's available on the internet. And in a lot of cases, there have been copyright infringements on these models because they're trained on things that they should have licensed first. So in this case, now they are doing after the fact. I mean, even today, when you ask ChatGPT, it can answer a lot of questions about Disney characters, right? And so I think the licensing really gives an avenue to Disney to monetize, the content that they have there. They spend almost $35 billion a year. Even Netflix spends $18 billion a year, although a lot of that Netflix content doesn't really flow into these chatbots. But you could argue, companies that spend on content, now they can license their content to these model providers, and that can be a high-margin stream of revenue.
Explain, though, the financial agreement here, though, because it's Disney putting $1 billion into OpenAI. What's the reciprocity financially?
OpenAI is paying a licensing fee for all the characters that they're using.
Okay.
I don't know if they're paying, for certain use in terms of consumption or number of calls.
Okay.
But clearly there is an element where OpenAI is paying Disney for the licensing.
So we don't really know, though, the actual.
We don't know
okay, gotcha. All right.
I did think it was interesting, too, that, okay, maybe you're going to see the animated character, but you're not necessarily going to see actual people, Disney Channel stars, for example.
Yeah, and look, I think a lot of this is TBD in terms of how the short-form videos will be created. At the end of the day, OpenAI wants their influence not just through text-based chatbots, through image generation, through video generation. In fact, I would argue they are competing with the likes of Meta and YouTube in terms of AI-generated content. And look, if people end up spending 5-10 minutes a day, that's taking away time from these social media platforms. And that's why Disney missed out, because they didn't have the user-generated content.
Yeah.
Now they could participate in that trend.
Well, investors seem to like what they hear. A slow start to the stock on the day, but now up about 2% as we move closer to those closing bells. Mandeep Singh is the global head of technology research over at Bloomberg Intelligence. We'll be back in a moment, counting you down to the closing bells right here on Bloomberg.
When you think about 2% productivity growth, you can grow the economy at 2% without adding 1 minute to the hours worked. That's what's happening. And now productivity set to inflect even higher with generative AI.
Russ Brownback over at Blackrock, kicking us off to the close just about 50 minutes ago. A discussion here about the productivity gains from AI and the impact that has on the economy, and more importantly, how it reshapes what the Fed has to talk about over these next few meetings.
Yeah, absolutely. Yeah. I like the line of questioning you've been pursuing. At what point does this become a conversation at the Fed? We know that they certainly have a lot to talk about when it comes to inflation, when it comes to the labor market. You take a look at the market right now. We saw that big pop coming out of the press conference yesterday. Not quite the same enthusiasm of today, though. Still higher by about 0.2%. Oracle spoiling the party a little bit, down about 10.5%.
Absolutely, and Oracle, of course, one of the biggest stories of the day, and could potentially be one of the big stories going forward for the AI trade. And just a reminder, we are going to get another big earnings report that could be a barometer for the AI trade out of the chip maker Broadcom in just a few minutes when we get the closing bells. To count us down to those bells is Steve Sosnick, Chief Strategist at Interactive Brokers, joining us here in Studio 2. Steve, great to have you here.
Good to be here.
I do want to start off first just talking a little bit about what we learned yesterday from the Fed. And I know the 25 basis point cut, that was baked in. We knew there was going to be dissents. But there was some interesting commentary from Jay Powell that seemed to talk about a growing divide right now, not so much just about what the Fed should do next, but just really about what the Fed's focus at all should actually be.
Well, that to me has been one of the bigger questions, is the dual mandate is coming into question here. Not their of how they're going to approach when the different parts of the mandate diverge. So, stable prices, you had a guest earlier who said, stable prices are fine because they're not moving. I would focus on the first derivative of prices, not the second derivative. Inflation is moving in the wrong direction. Prices are going up, so they're doing it at a stable rate, but it's still higher. But at the same time, you have the maximum stable employment portion. So those do come into conflict. I think the balance has been toward focusing on the labor and less on the inflation, because heck, we've been above the Fed's target for 5 years now, and they really haven't necessarily done too much about it.
Well, that's my question. Leads me to my next question, which is whether the rate cuts are actually going to be good for financial markets. I know history says, lower rates, obviously that changes how you value things, and in theory that makes it better. But if it is accompanied to some degree or another by an increase in inflation, even if that increase is modest, I do wonder if that potentially cancels it out.
It can, and that's why to me the thing I watch most is the 210 spread, which has been hovering around 60 basis points. That's where it was earlier today. I don't have it right up in front of me.
Yeah, it's at 61 unchanged.
That is creeping to the higher end. Now we got about 75 during the tariff tantrum. We've gotten up to about 65, but definitely it's one of these that we could, if we start to move up towards sort of the 80, 90, 100, one full percentage points, the levels that prevailed not that long ago, we can actually start to, that would be telling me that the bond market is getting fears of being unmoored on inflation. Gold and silver are telling you that people are nervous about this, but I'll focus on the bond.
Can I just stop you there for a second? Because Jay Powell was asked about this, and he seemed to dismiss the increase in yield that we're seeing in the long term. He basically kind of said that was more a function of a bet on the economy or something, like a positive bet on the economy.
It can be.
Okay.
And that's the problem, is it's so hard to unpack it. Gold and silver, I can make an argument that they're an inflation hedge. I could also make an equally good argument that they're the anti-dollar. As far as the long term, as far as the long end of the curve, I can make a great argument that it's about inflation expectations. I could also argue that it does, in fact, reflect a stronger economy and therefore less need to cut and, in fact, raise. So there's so many moving parts, and that's why I'm going to try to keep it. That's why at least I'm sort of focused on this yield spread, because I think right now, if you start to see particularly what I would call the bearish steepener, where you don't really see the 2 years go down anymore,
right,
that becomes a bigger issue.
That's what I was going to ask, Steve. And I will say, when it comes to Jay Powell's answer there, it's certainly a difficult circle to kind of square, because he also maybe expressed some worried noises about the labor market. But let's talk a little bit about the dynamic of that steepening. So it sounds like it would be more concerning if it was the long end driving the steepening versus, the front end maybe dropping down in anticipation of rate cuts.
Yeah, and part of the reason we steepened yesterday, again, in a minor way, is that the short end of the curve went down faster than the long end did, and that's okay. I mean, that was basically the markets, again, taking Powell in what I would call it in a Goldilocks approach. This was not a hawkish cut. I called it a Goldilocks cut. I've referred to Powell many times as Goldilocks in a suit because of his amazing ability to always be not too hot, not too cold, and thus giving traders the ability to basically parse whatever they want from him, and so there's always something positive in there to parse.
It wasn't the pigtails that led to Goldilocks?
No, not the pigtails, no. Although the deadhead stuff maybe gets you in that direction.
It's pretty cool, I gotta say. But let's talk a little bit, too, about the state of the AI trade. Oracle has been one of the stories of the day, and it seems like investors kind of pushing back on the massive amounts of AI spend that Oracle has planned. Do you think that this is Oracle specific, or do you think that there's something to extrapolate out from what we're seeing to the Oracle reaction to the broader landscape?
Some and some. I think the bulk of it is Oracle specific. And I went back because I knew I'd been skeptical about this whole OpenAI $300 billion thing. And I realized I first wrote a piece kind of wondering how this was going to get paid for on September 22nd, and then I wrote a second one on October 6th. So I like to say that this has been bugging me for a while. My question is, in this situation is, okay, so this whole ecosystem is built on a huge amount of commitments from sort of fledgling companies. Yes, the hyperscalers are having these commitments, are making these commitments as well, and they're well positioned to do it. Nobody's really questioning whether Microsoft can pay for it, even though there might be some question about moving more toward an asset-heavy rather than a software-heavy type of business model. But put that aside, they can pay for it. How is OpenAI, a company that may or may not make $20 billion this year, going to pay $300 billion to Oracle over the coming 5 years, let alone all the other commitments they have to make? And how are companies like Anthropic and Perplexity and stuff like that going to do this? I think back to the bandwidth craze of the late 90s, where everybody needed to build bandwidth, and I will stipulate it was necessary, and the internet was everything we all hoped it would be, and then some. But where's Global Crossing? Where's Northern Telecom? Where's Lucent? They all fell by the wayside. And to that further model, where we're all where everybody's banking on OpenAI and friends. If we also flash back to that era, we'd be using Netscape browsers, connecting through AOL, and using Yahoo as our search engine. So this is a very fluid situation. Oracle, to me, is the canary in the coal mine.
All right, Steve, you have to leave it there, and kudos to you. I think you're the first person on the close to bring up Global Crossing. I completely forgot about them. Steve Sosnick, a font of knowledge, a wealth of experience, chief strategist at Interactive Brokers. With those closing bells moving ever so closer, a mixed day on Wall Street with the small caps outperforming the big. A full breakdown of all of today's market action starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld taking you through to that closing bell with the global simulcast. It started. Carol Masser, Tim Stenovic, they're in the radio booth. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube. Post-Fed Day, post-Oracle day.
Yeah.
And you take a look at the price action, Carol Master, and what does it tell you?
I know we've had, what, 2 records, Dow and S&P intraday. Like, I don't know. They're little moves, at least certainly for the S&P 500. But, yeah, who'd have thunk? And I'm not quite sure what to make of it.
Well, it's post-Fed day, it's post-Oracle day, but it's still Costco day, Broadcom day, RH day, and Lululemon day. So there's still, companies that are reporting how consumers are doing. We're going to hear from all of them in just a few minutes. And also on the AI trade for Broadcom.
Yeah, absolutely. I was going to say, I feel like there's one company in that bunch that could really determine the direction of trading when we come in tomorrow morning. That, of course, is Broadcom. It's interesting to see this pushback on Oracle. And the question Romaine and I have been talking about is basically whether this is Oracle specific, those shareholders saying this is enough when it comes to AI spending, or whether or not, this extends to other companies in the space as well.
Well, I'm glad you bring that up, Katie, where I feel, because it brings me to my favorite word, a word I just learned a few months ago, which is the Ouroboros.
Ouroboros.
Ouroboros. I'm getting
it.
There. Because it gets to this, in all seriousness, we talk about this idea of whether it's Oracle specific, but when you look at the interconnectivity between the deals it's made with NVIDIA, with OpenAI, et cetera, you start to realize that maybe whatever is Oracle specific, well, unfortunately, might actually be specific to some other companies as well. We do get the closing bells here in New York on this Thursday afternoon, and a mixed bag. But as you were just alluding to, you take a look at the S&P 500, a gain of just about 15 points. That may not look like much, but it's 6,900 and change. That's going to be good enough for a record high, up about 0.2% here on this Thursday afternoon. Meanwhile, the NASDAQ Composite and the NASDAQ 100 going in the opposite direction, down about 2 to 0.3%. The Dow Jones Industrial Average is going to close at a record high, up more than 600 points or 1.3%. And the Russell 2000 getting in on the action as well. In fact, that's your relative outperformer on the day, up 1.2%. to a fresh record high.
All right, I'm going to go back to the big caps, the S&P 500, though. Even though the index overall...
What day, Carol, pop quiz, did the Russell 2000 start trading?
Oh, my gosh.
I don't know.
I'd say early 80s.
Why do you know that?
1979. You were close, Tim.
Look at that.
And thank you for guessing, Tim Stenovic, and playing along.
You're welcome.
All right. Well, sorry about that.
I thought you were going to ask her what an Ouroboros is.
Oh, God. It's a snake that eats itself, or a dragon.
This is a reference to the cyclicality of the AI funding?
Exactly.
Okay.
It's a daisy chain.
Moving right along. S&P 500, despite a slightly higher gain in the overall average.
Circularity, excuse me.
You
Should we let
have
Carol talk?
seen most names. My God, it's like being around my family. Most names in the S&P 500 up 366 names to the upside, 133 to the downside, 4 unchanged. Go ahead.
All right, let's talk about the circle. Pretty good breath when it comes to the sector performance. 8 of 11 sectors finishing in the green, 3 in the red. Materials, your outperformer in a big way. That sector higher by 2.2%. Financials not too far behind, 1.8% higher. Industrials, healthcare also catching a bit. In terms of what didn't perform today, you can see information technology certainly worth a big chunk of the circle. But it was communication services down 1%. That was your worst performer, Carol.
Okay, Katie. All right, let's get to some of the individual gainers on this Thursday. I'm going to go to the fertilizer companies. We saw Mosaic. What?
Go on.
Did you grunt?
I think he was just shocked at Mosaic being up so much.
Okay, Mosaic up 6.2% here at the close. We did see fertilizer stocks as a whole moving higher. This is after Ukraine said drones had hit 2 fertilizer plants in western Russia on concerns that geopolitical tensions will affect supply chains for key crop nutrients. Keep in mind these affected plants relatively small in context of our overall fertilizer capacity, but our own Bloomberg intelligence analyst Alexis Maxwell weighing in saying the market priced in expectations for peace, which they're now reversing. So that's why you saw those stocks on the move higher, concerns about shortages, but that certainly plays into those who can deliver and probably charge more and all that good stuff. Hey, Eli Lilly, at its highs today, up about 3.8%, finishing the day with a gain of about 1.6%. A next-generation obesity shot from Lilly helped patients lose almost a quarter of their body weight in 68 weeks. Patients on the highest dose of the drug experienced a more than 62% reduction in knee pain, according to a self-reported questionnaire. We are finding these drugs, you lose weight, your overall health improves, but this one, some outperformance there, and so you definitely saw investors moving moving into Eli Lilly. And then just quickly, Disney, certainly on our radar today, up about 2.5% at the close. Disney agreeing to invest $1 billion in OpenAI and license iconic characters for use on the startup's AI video platform. We thought this was kind of interesting because Disney's so protective of their IP, but nonetheless, they definitely wanted some kind of relationship with OpenAI, and so investors seem to like it.
And as Hannah Miller reminded us, they're suing Midjourney for creating stuff with characters. So anyway, those are the gainers. I got the decliners. We got to start with Oracle, down close to 11% today, 10.9%. Worst single day since January. At one point in the session, it was down the most, going all the way back to 2001. This after the company escalated its spending on AI data centers and other equipment. It erased more than $100 billion in market value. CapEx, about $12 billion in the quarter. That's an increase from $8.5 billion in the preceding period. Fiscal second quarter cloud sales increased 34% to close to $8 billion. Also, among the worst performers in the S&P 500 on a percentage basis, Robinhood Markets, down 9% today. This after the company reported that November trading volume saw a month-over-month decline due to equity and crypto trading. November assets under custody are $325 billion. This stock still up more than 230% so far this year. And finally, shares of Rivian fell today by 6%. They took a hit after the company unveiled its own AI chip designed to replace NVIDIA tech as part of a broader push to enhance the automated driving vehicle capabilities in its future vehicles. So it's going to equip the upcoming R2 SUV with Rivian Autonomy Processor 1 chips and a new LiDAR sensor that will help Rivian's efforts to eventually offer autonomous driving capability. Once again, Rivian shares down today, 6%.
All right, a quick check on yields, and we should just point out, not a whole lot happened today. In fact, that screen there, we're just going to call it unch across the board here. We did get obviously a big move lower yesterday here, but yields have still been relatively elevated relative to where they had been just a few months ago here. Again, a market right now still trying to suss out what the Fed does next. We should point out we had Steve Sosnick on a little bit earlier who was talking about this increase in the yield curve, particularly with the 210s, and saying that that's something that we should keep an eye on, though. I think we have some breaking news crossing the wire right now on Lululemon.
Absolutely. We'll get to the earnings, but let's talk about the management change that they are announcing in a statement, announcing that Calvin McDonald plans to step down as CEO and member of the company's board of directors effective January 31st, 2026. Also announcing that Marty Morfitt, she is chair of the board, will take on an expanded role as executive chair effective immediately to, and this is according to the release, ensure the continued execution of the company's near and long-term growth strategy during this transition.
That's a big deal.
You can see the shares spiking right now.
Yeah, Calvin McDonald there
they
since...
need to spike a lot more because they're down like 50% this year.
Yep.
Yeah, Calvin McDonald there since August of 2018, it looks like. So interesting to see these changes. Let's go through some of their financial results, folks. Let's go right to the outlook. Fourth quarter net revenue, $3.5 billion to $3.59 billion. The street estimate was at the higher end, $3.59 billion. Let's go back to the third quarter. Third quarter EPS, $2.59. That's a beat. $2.22 was the street estimate. Third quarter total comp sales ex FX up 2%. The estimate was a gain of 0.72%. So there's some outperformance there. International comp sales for the third quarter, ex currency, up 18%. That too is way above the estimate, street estimate of 10.7% higher. And gross margin for the third quarter, 55.6%. Again, that's a better number than what the street was expecting. They were looking for 54.4%. But again, in terms of the outlook, go ahead, Romain.
Yeah, sorry, I didn't mean to cut you off, but I'm starting to read through this release here, and I am curious about this idea that they don't actually have a successor set up for McDonald just yet. They're basically starting the search, and it's never really a good sign when you basically announce the departure of the CEO without actually announcing who they're actually replacing that person with. So they basically got, what, if my math is correct, about 7 or 8 weeks to figure this out before he leaves at the end of January.
Well, look, I mean, you mentioned it this year. Shares down 51% so far this year, Romain. Shares down from a 2023 high, more than 63%. There have been a lot of critics out there, not just of the company, but even people formerly involved in the company. Chip Wilson, for example, has been outspoken about what he thinks should be done at Lululemon. So I agree. Never a good sign when they don't have a successor actually lined up. But we'll see who they pick and if he or she can turn the ship around.
Yeah, a bunch of questions, no doubt about it, on that call with analysts and investors. Stock, by the way, up 7.2% right now in the aftermarket. All right, guys, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. Katie and Romaine, of course, continuing there on TV on the close. Tim and I continuing on radio right there on Bloomberg Business Week Daily. We'll see you again, same time, same place tomorrow.
And our coverage continues here on Bloomberg Television. We're going to break down those results that we just got out of Lululemon in just a moment. Also awaiting earnings out of RH, Costco, and Broadcom. Stick with us. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Markets closed just about 11 minutes ago. You did have record highs on the screen, but not necessarily for the big tech stocks, and it actually led this rally all year long. The Nasdaq pulling back by just about 0.4% on the day, but we did get a record high for the S&P 500, a record high for the Dow Jones Industrial Average, and a record high for the Russell 2000 as well. Maybe some sense here that what we've seen in this market is less sell-off and maybe a little bit more of a rotation. A big part of that rotation you can see on the screen behind me here, the big sell-off today on Oracle, largely because of concerns about the AI build-out. Not so much that the build-out isn't happening, but whether these companies are actually going to be able to continue to finance that build-out without completely eroding any potential profitability. NVIDIA getting hit in that downdraft as well. And where is that money going? Well, it's going into names like Carvana, up now for the 13th straight day. And then you have Lockheed Martin also on its longest win streak in quite some time, up about 1.5% here. The idea here that there are other pockets of this market that can potentially provide some value. And that brings us to our top story, the great rotation to end the year. In the first 10 months of 2025, 9 of the 10 biggest contributors to the S&P gains were AI plays. NVIDIA, Microsoft, Palantir, Oracle, some of the more notable names there. But since the end of October, that has flipped just a bit. Just 5 of the top 10 names are directly tied to the AI trade, as stocks like Johnson & Johnson, Eli Lilly, Goldman Sachs, and even Walmart have all creeped to the top of the leaderboard. That rotation, part AI exhaustion, but also part renewed conviction on the stability of the U.S. economy and maybe ratification of the idea that despite the dominance of AI spending on GDP, consumer spending is still what matters. And we are getting a read into that consumer spending here in the after hours trade as we await earnings out of Costco, await earnings out of RH, and we just got earnings out of Lululemon. The pop in the stock that you see here, up about 6%, has a little bit less to do with the numbers and a little bit more to do with leadership. The CEO, Calvin McDonald, going to be stepping down from the company at the end of January. 2 co-CEOs right now put in place on an interim basis while the company starts to search for a successor. Janine Stichter joining us right now, Managing Director of Consumer Equity Research over at BTIG. And let's start with the departure of McDonald. He's been there since 2018. We had a chance to see what he can do. The last couple of years haven't pleased investors. Do you think this could potentially be a good change for the company?
I think it's a positive change. Look, I think Calvin did a great job in scaling the business into a global leader for a period of time, but I don't think he was the right leader at the right time for this business. And what we've seen is throughout the past year and a half, there have been constant promises of having diagnosed the problem, trying to figure out exactly what's not working, and then making small changes towards fixing that goal. And none of it has really served to reaccelerate the Americas. You can see in the report today, Americas was essentially in line with what we expected, but it was down year over year, and we just haven't really seen any of the product changes really make a difference. So I think what we need here is a harder reset, an outside perspective, maybe some larger scale changes that might take some more time to work out. And I think you just need a shakeup at this point to get some fresh ideas into the company.
We'll talk about sort of the performance of the company, both in terms of what we learned out of the earnings report today, but even in the quarters leading up to today. What is the state right now of Lululemon?
I think there's two sides of it. On the international side of it, things are growing. They have a lot of growth in China, a lot of opportunity there. But in the U.S., it's really been stagnant. And some of that might be a natural maturity. At a certain point, you do hit a revenue level where it just becomes harder to grow. But I do think there have been self-inflicted execution missteps. You can see it with some of the products that just aren't resonating. And it seems like they've tried a lot of different things, but nothing has really served to reignite that business. So I think we're at a point where you just need something different. from a merchandise standpoint, and maybe something from a marketing and merchandising standpoint too. I think there just needs to be some fresh ideas because the U.S. business has essentially been stagnant for the better part of the last 2 years.
How much of this is Lululemon specific, and how much of this is just kind of the idea that a category that it effectively established, athleisure, is now being done by everybody, whether you're Nike or whether you're an off-brand company, everybody's got an athleisure lineup in one way or another?
The category is certainly a lot more mature than it's ever been. And if you think about what consumers are buying right now, I think there's also some fashion headwinds. Denim and jeans are making a comeback. Dressing up is making a comeback. We're not in that post-COVID world where everyone was wearing their leggings all day long, and that was kind of the fashion statement to make. So there's certainly some category challenges that everyone has to deal with. There's also more competition, as you mentioned. But I think that just goes to show companies like Alo in particular are doing fairly well right now. So they're even in a more mature category, there is opportunity if you can excite the consumer, if you can merchandise properly to still gain wallet share.
So I am curious. I know it's going to be probably some time before we learn who the permanent CEOs are going to be. But when you get to the conference call and you hear management have to explain why McDonald's leaving and sort of what the strategy is going forward, what do you think they can say today that might actually, provide a little bit more hope for investors?
I think it's going to be an admission that there were bigger picture challenges than just needing more core franchises or more color or more of a certain size. We need a fresh look at this business from an outside perspective, and I think they're hoping that by making this change now, we can have that sooner rather than later. So I think this is just kind of a hard reset, and that's what we've been hearing from investors, that they just want a hard reset of this business.
All right. Well, investors seem to be relatively pleased so far. The share is up about 7% in the after-hours trade. Janine Stichter, Managing Director of Consumer Equity Research over at BTIG. Meanwhile, also moving to the upside right now is Broadcom. The share is up almost 3% after reporting fourth quarter net revenue of about $18 billion. That's a beat. The street was looking for about 17.5. Adjusted EPS, $1.95. The street was looking on average for about $1.87. And we should point out Semiconductor Solutions revenue, the key core part of this company, $11 billion in revenue, slightly above street estimates. As for the guidance, the company says that for the fiscal first quarter, the quarter that we're currently in, look for revenue in a range of about $19.1 billion. That would be well above what the street was looking for of roughly about $18.5 billion. Again, we're going to dive a little bit deeper into that in just a second. Costco also out with its results as well here. Those shares a little bit under pressure. EPS in its fiscal first quarter, $4.50. That's a beat. Street was looking for $4.28. Revenue, though, relatively in line with estimates at about $67.3 billion, with comp sales, excluding gas and FX, up about 6.4% in the most recent quarter. We'll be back in a moment. This is Bloomberg. Earnings from Broadcom just crossed the wire. Of course, this is the chip maker. It basically builds custom chips. A lot of those chips these days, of course, going to the big hyperscalers like Alphabet. The share is moving higher in the after-hours trade as the company did beat on both the top and the bottom line in its most recent quarter, and its guidance for the current quarter. The fiscal first quarter says expect about $19.1 billion in revenue. That's above what the street was looking for. The company also says that it sees a lot of the momentum from AI carrying over deeper into the current fiscal year, and it expects AI semiconductor revenue alone to double on a year-over-year basis to about $8.2 billion. Let's bring David Traynor into the conversation. He's the CEO of the research firm New Constructs, and he has an unattractive rating on the company. All right, David, let's talk about not so much the numbers today, but exactly where does Broadcom actually fit into the broader AI story?
Broadcom is a really profitable, great business. It's going to be one of the players for sure. And the market clearly understands that. I mean, the valuation for Broadcom is even more expensive than NVIDIA. It's why we have an unattractive rating. Look, we think all the good news is priced into it. That doesn't mean the thematic tailwinds are going to go away and it won't still keep going up. But we're in definitely a very hype and exuberant period, I think, for AI. And Broadcom is one of the most well-liked or hyped stocks out there.
Yeah, I mean, the share is up something like 75%. This is basically going to be the best year it's had since at least probably, 2010, 2011. And it gets to the idea, though, David, and as you know this, there are a lot of people that look at these valuations and they dismiss the high valuations because they say what's happening with AI is going to be transformational to the nth degree, and that in and of itself should maybe require maybe a little bit looser way of valuing some of these companies. Is there not a case for that, or is that just kind of a salesmanship, marketing, if you will?
Romain, I think there's always a case for questioning the existing regimes. And I think AI for sure is transformative. And I think we're also seeing, a wave of transformative technologies, the wave's coming faster and faster. And I think, but with each wave, we've also seen that, the market gets a little ahead of itself each time. And I'm not here to say that the entire market's going to crash. I don't think that, but I do think that there are pockets of overvaluation. We call them micro bubbles. And Broadcom is one of those. Number one. Number two, Romain, I think, valuations do and don't matter, but I think to some extent they always matter. And when you do some of the simple math on generally sort of the AI spending, and I think this would trickle down to some of the really expensive stocks as well.
Yeah.
The implied cash flows to justify or to earn adequate returns on all this spending are outrageous. They imply something like 100% of all advertising revenue in the world, right? I think JP Morgan did a quick little study on that. Michael Burry and some others have just done some back of the envelope math that looks at, okay, if we're going to spend this much, what kind of revenue and profit are required to get a good return on that? 7, 8, 9% at least, right?
Yeah.
Some would argue 12, 15% is what you get. And the numbers required to do that, just the math.
Yeah.
Well, people are going to say math shouldn't matter here. But at the end of the day, math does matter at some point. And if you're looking at implied revenues greater than 100% of, some of the biggest revenue pools in the world, it gets a little bit shaky.
Well, the math, and it's funny you say math matters, because I think for a while it didn't, but certainly we saw that in a big way today with Oracle, where I think a lot of people, they looked at that gigantic backlog. Any company that says, hey, we got $500 billion in orders, you'd be popping the champagne. But then you look at the negative free cash flow tracking at well over $10 billion this year. You look at a debt load that's about to cross the $100 billion mark. Do fundamentals matter again? And specifically, I'm talking about for the AI trade.
Yeah, Romain, I think you bring up a great point. We wrote a piece about this a couple of weeks ago, talking about the AI winners and losers. And we pointed out Oracle is going to be one of the losers. And I think what's going to happen is that fundamentals are going to matter, and it's coming at us fast because the pressure to keep up in the AI race is so high. And by pressure, I mean spending. So Oracle and Meta are spending beyond their means to try to keep up. They're throwing haymakers out there. You see it all the time with Zuckerberg, like offering people $100 million plus pay packages because he knows if he doesn't get on base now, he's going to lose out to the Apples and the Googles and the Microsofts of the world who can continue and afford to spend these smaller players into the ground. Amazon.
Do you think, is this like a winner take all type of proposition when it comes to AI? And I ask that particularly maybe in context of your career, because I think about, the internet boom and the software boom that we saw in the 90s when you were starting your career. And there was that talk, the idea that this was a race, not necessarily to be the best, but just quite frankly, to be number one. And I wonder if that's where we are now when it comes to AI.
I think so, yes. Now, I don't think it's just going to be one. But I think that the process you're describing is the same as it's always been. I mean, think about the automobile industry when it was first born. There were dozens of competitors, right? And we've now consolidated down to a few. I think we'll see the same thing with AI. We've been seeing the same thing with technology and big players for a while as well. And so that's kind of what we were saying in our AI winners and losers piece. We see 3 winners, we see 3 losers. The main distinguishing characteristic of the winners is that they can afford to continue to spend like crazy, and it's going to push firms like Oracle to the financial brink, which is exactly what we're seeing. And that's what I mean about accelerating the importance of fundamentals. When you're forcing these companies to confront the fact they cannot fundamentally compete, they're overspending, they're overdriving their headlights, then we're going to start to see some cracks as people pay attention to the fact that, look, the fundamentals don't make sense here.
So you are very fundamental driven, very data driven. When you look at the fundamentals, David, who do you like in the AI space?
Well, I tell you what, I think Google's the best positioned overall because they're the only company that has the cash flow to continue to afford it, makes their own chips, has an AI model, and has all the cloud and storage they need. They got the infrastructure. But the problem is, I wish you'd asked me this question a few months ago. The stocks are up so much that even it looks a little too expensive for us. So We tend to be a little more conservative on that front, and we look for smaller, unnoticed players. But I'll tell you, a couple of those, Photronic, P-Labs, even those have run through our target prices already. So we're kind of back to the drawing board, trying to find something that looks cheap in this environment. And I'll be honest with you, it's not easy.
All right, David, I have to leave it there. Always great to catch up with you. Let's not make it so long next time. David Traynor, CEO of New Constructs. When we come back, we're going to check back in on the retail sector and Lululemon.
I love Costco as a brand. I respect them immensely because because people pay to get in. I think that's such an incredibly powerful element to the things are never in the same place. You don't know what they're going to have in stock, but yet the clarity of what they do, the followership that they have, I have that same ambition for Macy's, Bloomingdale's, and Bluemercury in very different businesses. There's love for the Costco brand, and the experience that people have is consistent enough that it reinforces that. That's what I want for Macy's.
Part of the conversation that I had with Macy's CEO Tony Spring earlier this week, I asked him specifically what other retailer other than Macy's Inc. that he admires most, and he actually flagged Costco. Basically said it's one of his favorites, both as a shopper and as a CEO. They're out with their earnings just now here. Quarterly profits continue to rise, a sign of that stickiness that he talks about with regards to their shoppers. The share is not getting a whole lot of boost here on the day, but you are seeing a little bit more of a development with Lululemon. Again, there you had top and bottom line numbers that on the surface seem to please investors, but there seems to be a little bit more optimism about changing up the guard in the CEO suite with Calvin McDonald going to be stepping down at the end of January. A search for a new CEO is on. And that's just really an excuse for us to talk about the retail environment here in the midst of this holiday season. Naveen Jaggi joins us right now. He's the president of JLL Retail Advisory Services, who has his finger on the pulse of what's going on in retail and specifically in brick and mortar retail. And I do want to start there, because that interview I had with Tony Spring, we actually did that at a mall. And one of the more interesting things was to see all the foot traffic in that mall. And we had a guest on earlier this week who was kind of going through some of the numbers of holiday foot traffic in the malls. And it was up. I mean, it was American Dream in New Jersey was up 9%. King of Prussia in Pennsylvania, 7%. Mall of America in Minnesota, 10%. Sawgrass down in Florida, 8%. I could go on and on. Tyson's Corner up 11%. I assume you're not surprised by those numbers.
Not surprised at all.
Why not?
Consumers like to shop in the physical location when they're given an opportunity. I think both the owner, the investor, and the retailers have gotten smart about giving those consumers a reason to get out. And we saw an uptick right after the Thursday holidays of Thanksgiving when Black Friday had an uptick in shopping foot traffic. The number one reason why they chose to go shopping was to go shopping physically. That was the number one reason why to get out and shop, not online, not at their computer, because it was entertainment. It was something to go do socializing with, to go eat out, to have an event outside of the house. And that tells me people, when given a reason to shop physically, will always take that opportunity.
That gets to this idea of why we saw a drop-off in foot traffic to brick and mortar, whether that was truly indeed people just saying, okay, we found something better and more convenient, or whether it was the brick and mortar retailers basically just not adapting and giving, as you maybe alluded to, the idea of reason for those people to come in.
That's right. Well, I think we thought that we solved the puzzle during the pandemic. We thought that once people were given a chance to shop at home, they'd never shop at brick and mortar again. There was all this clarion call for the fact that malls were going to decline and die. People predicted the department stores were going to go away in 10 years. That didn't happen, actually. Quite contrary. Once the doors were open, I'm from Texas. We were shopping in June and July of that same year. You were given a chance to go shop, you went shopping. Grocery stores don't typically do well online. And we saw that once you got a chance to get outside, you will go back and shop physically. And I think the retailers have gotten smarter about it, and investors have gotten smarter about making sure that their retailers have good-looking stores, have a reason to go out and shop.
Well, that's it. Well, I mean, all the malls I just mentioned, I mean, these are some of the premier malls in the country. And anyone who's walked through them, you know, they're nice, they're clean, they're updated. They have a really good selection of not just stores, but of services and experiences as well.
It's a top 10 mall in America, and the traffic's up.
But are you seeing more, I guess, of the, let's just say, the second-tier malls, if you will? Are they going to step up their game, or are they just going to go away?
I think it depends which market they're in. Demographics demand everything. And if those retailers don't match the demographics of the community around that shopping mall, they likely won't go at the same level that you would for a Houston Galleria or King of Prussia, any of the 555 malls that we have across the country, those malls in America, they will always be there. They'll always do great. I think the question is when you get to a B mall or a secondary mall, it's really the market, it's the city, and what are they giving the consumer? And if it's not just a destination, if it's only for value, they will not bring the consumer in the next 5 or 10 years.
It gets to the idea, too, of we talk about experience, but there's this idea that shopping to a certain extent has become very transactional.
Absolutely.
Certainly with online. It's just like we want what we want, we pay our money, and we move on. That's obviously, from a business perspective, not always the most profitable.
Sure.
As these malls adapt, and for that part matter, department stores and the retailers within those malls here, how far do they need to go with that experience? Because I feel like some have gone to the point where you walk in and there's no merchandise even buy.
That's right. I mean, at the end of the day, you have to give somebody a reason to shop, not just to go and get a skating rink environment or something to eat. You have to give them a reason to stop. And I think we think about dwell time a lot, right, in retail. How long will that person stay? We do a lot of data surveys through Placer AI and other data resources, and we keep seeing over and over again the story's the same. The longer the consumer stays, the more they'll spend. I think the investor and the retailer have gotten into that and said, let's give the consumer quality product, quality atmosphere and environment. So it's not just about entertainment, like skating or darts or bowling. It's about just the value of shopping and getting something out of it that makes you and your family want to go, not just for you to buy something.
With regards to the demographics, is that just population demographics of where the U.S. population is shifting, or is it more about income levels? Like what do you look at when you're trying to look for what could be a successful location for a mall or any sort of
income levels will be the first thing we'll look at, and we'll look at the demographics by population and by population quadrants and cohorts. Look, we know that that 18 to 32 age group is the one that spends a lot of money. Baby boomers are still driving the economy. Until baby boomers peak out and Gen X comes in and starts buying the things that baby boomers are buying, we're going to likely see that older demographic, that 55, 60, 65, still drives a big part of the economy. And that's probably going to take about 10 years before it's that handoff to Gen X.
I'm curious, did the older generation ever really abandon brick and mortar?
They did not.
They did not.
No.
So they kind of stuck. So it's more the younger generation who maybe didn't either grow up with it or maybe didn't.
And quite candidly, I've got 3 adult children. They don't shop online. They shop physically. For them, they understand the importance of being able to touch something, look at something, and want to actually buy it after experiencing it, as opposed to going on and buying paper towels? Sure, you can do that. But you're not going to buy a $30, $40, $50 item just because it's online.
Are the economics, though, of brick and mortar a little bit more in line with the economics of what you would have to compete with regards to a pure online e-commerce company?
I think nowadays there is no such thing as pure. The reality is that it's all one channel. The best retailers have combined both their online experience with their physical experience, and they've done a great job with it. Whether it's Macy's, whether it's J.Crew, Apple, you name it, some of the best retailers, Restoration Hardware, they make it seamless. If you make it seamless, consumers aren't thinking about which channel to buy from. They're thinking about just buying at the place they enjoy the most.
All right, Naveen, always great to get some insights out of you.
You had enjoyed it.
Naveen Jaggi is the president of JLL Retail Advisory Services. All right, as we keep an eye here on the broader market, and particularly on the after-hours trade, you take a look there and see the biggest mover right now in the after-hours is Lululemon. That big announcement today that Calvin McDonald's going to be stepping down as CEO in the end of January. We did get some earnings out of Costco and Broadcom as well, still awaiting some earnings out of the retailer RH. We'll bring you that as soon as we get it, so stick with us. This is The Close on Bloomberg. With Lululemon earnings out, Costco earnings out, and we are still awaiting those earnings out of RH, it's a good time to dig a little bit deeper into the health of the consumer and the sentiment of the consumer. We're coming off the Fed's third straight rate cut with risk of further pricing pressures on the table. It's a bit at odds with the solid holiday spending figures rolling in from retail data tracking companies, including the National Retail Federation, Accenture, and Colliers, all of whom have joined the close in recent days to share their findings. We're going to add another to the mix. Katie Thomas joins us right now, the lead at the Kearney Consumer Institute. All right, Katie, so what are you actually seeing when it comes to what we're buying this holiday season?
Yeah, coming into this holiday season, we were feeling like we were going to see conservative growth, and that's about what we're seeing right now. So in talking to consumers, about 2 out of 3 said they would spend as normal, which is both good and maybe concerning, right? A lot of people are going to spend, but a third of consumers are considering holding back. Now, when all is said and done, what tends to happen around the holiday season is we like to get out there and spend. And so we tend to do that, and that's essentially what we're seeing, particularly in some of your usual suspect categories. So apparel's doing well, beauty's doing well, and resale is actually a bright spot where people are much more likely to gift resale than in prior seasons. So So that's just kind of in general how this season's starting to shape out.
When you say resale, you're talking about like thrift
yeah,
shops
exactly, like the
that?
real. So especially younger consumers maybe have that on their list as opposed to something new.
I mean, does that impact the type of numbers that we get if people are gravitating to secondhand items? Does that impact the total numbers in any way?
Not in a negative way, no. It's still getting out there and spending. And frankly, with the inflation we've seen lately, you know, a lot of cases what we're seeing with consumers is they feel like what's now the sale price was a full price not that long ago. So that's why we're seeing a lot of consumers question how good the deals and discounts are this year. It's not necessarily the numbers are that terrible, but it feels like the deals aren't that good. And just in general, that Black Friday and Cyber Monday haven't been as exciting as in years past.
Well, was there any concern coming into this holiday season that there were a lot of consumers that maybe didn't have the capacity to spend? The idea that maybe they were tapped out a little bit on their credit cards or maybe just not feeling good enough about the economy to want to open up their pocketbook?
Absolutely. I mean, that K-shape we're seeing with consumers is very real. So you see the top part of the K is spending, they're doing well, and then the bottom part of the K is really concerned and being thoughtful. But again, traditionally at the holidays, people really like to spend. And so they'll figure out where else to cut back or save in the new year. They're making tough choices, that's for sure, but they're still spending.
I'm not sure exactly what the origin of Black Friday was, but I am curious whether it's run its course for a couple of reasons. First of all, the Black Friday discounts, I put that in quotation mark, were being offered like at the end of October and some earlier. So not really Black Friday. In fact, some of the emails I got would actually just say like Black Week or something like that as tongue in cheek. But it gets to this idea that given the expectation for discounting, given how early some of these sales start, do we just need to kind of stop even talking about Black Friday, at least in the traditional way that we talk about it?
Well, I think anchoring on that as a day is still useful. We do see a lot of spend on that specific day, but ultimately what has happened is a lot has shifted online. So online is performing a lot better than stores this year, and some of the magic has fallen away as the season's gotten longer. So now what the interesting thing is, though, we've seen some retailers this year bring back doorbusters, and you saw consumers waiting in line in cold weather at 4 in the morning. And so it shows consumers are actually seeking excitement from the holiday, but it's due for an update.
Well, I bring that up too, and I'm glad you used that word because there was an experience to it all. I mean, I can remember, I'm going to date myself, but at a certain age, like you actually went out with your whole family to, take advantage of these sales the day after Thanksgiving, and in some cases on Thanksgiving Day itself. And I feel like that experience is just, I won't say it's not there, but it's certainly not at the critical mass that it used to be.
Yeah, absolutely.
Yeah.
I think some of it is what happened with that is it reached its inflection point, and then you had all of those sort of moments of hysteria or consumers getting upset and all sorts of riots and things like that. So I think that's part of it. But I think in general, when it comes to consumption, one thing we under-discuss is what you just described, is that people like shopping. So that's what we've seen. Even though consumers are increasingly being more frugal, they really like to get out there. It's a social activity. It's with their friends and family. It makes them feel unique. And so I think sometimes we underappreciate just how much people enjoy that.
What are your expectations for post-holiday shopping? We've talked with some retailers. They actually said they actually do a lot more business in some of the days and weeks after. It's partly because of gift cards, partly because of returns and things like that as well. That also gets people into the stores to a certain extent and gets them to buy more.
Yeah, we're going into 2026. We have a couple things we're looking at. One thing that we've been seeing a little bit building up over the last few months is what I'm calling bold over basics. So you're actually seeing people optimize their basics because they know they can get it for cheap. They can buy clothes at Costco. They can buy affordable skincare, but then they're going to go big on one big piece or one major look from an eye perspective or something like that. The other thing is what I call healthy-ish or anything that's health adjacent. So if you think of some categories that have been popular recently, air fryers, gut health sodas, they're all a little bit in that permissible indulgence category. That's another area that we think will do well in 2026 because it's kind of doing two things for you. It's like both a treat and functional.
A treat and functional. As a gift, though?
Oh, maybe not as a gift.
Oh, just for yourself.
Yeah,
okay, all right. Because I was saying,
you got to choose your own adventure.
Not to be picky, but if you're giving me a gift, just give me the candy.
Yeah, right. That's true.
Katie, always great insight. So you guys do some great research there over at the Kearney Consumer Institute. Katie Thomas is the lead there with our focus today here on the health of the consumer. When we come back, we're going to talk a little bit about politics and talk a little bit more about the revitalizations of cities, particularly Baltimore. I had a chance to catch up with the mayor of Baltimore, Brandon Scott, about his mission to make the city safer and, more importantly, more affordable. That's coming up next here on The Close. This is Bloomberg. The affordability crisis is top of mind for voters, for consumers, and of course, government officials alike. One mayor is making it his mission to help solve that. Mayor Brandon Scott. He represents the city of Baltimore. I had a chance to catch up with him and ask about his efforts to actually help affordability. And I also asked him about what advice he would give for incoming New York Mayor Zohran Mamdani. Take a listen.
The 10-year financial plan is about making sure that the city is in the best fiscal position to do those things, to lower the property tax rate in the city, to create more affordable housing, to be able to invest more in our infrastructures like schools and rec centers and pools and parks, things that we've done to historic natures in my first term and into the second term. We want to see that work continue, but also that we continue to have a balanced checkbook so that the city is in the best fiscal position structurally as well.
I'm curious about the balance of those improvements, as we've seen in a lot of other major cities over time, that as we start to see improvements, of course, that brings a new population to the city. I'll use the word gentrification for lack of a better one, and it raises a lot of concerns about a city that improves, but those improvements don't necessarily accrue to the longtime residents, but rather to the newcomers. How do you address that?
Yeah, I think that's why our strategy is done the way it is. It's a block-by-block strategy, and we're taking a strategy that really we're lifting up and growing to scale that we've seen work in neighborhoods. When you look at parts of East Baltimore that when I first came to city government in 2007 were mostly vacant, we're now seeing neighborhoods like Johnson Square and Oliver be occupied by people that look like me, that are from Baltimore, that used to be renters that are now homeowners in that neighborhood. When you think about the projects in my home neighborhood that I grew up in Park Heights, we want a little bit of what I call regentrification. All those people that I grew up with that were pushed out into Baltimore County, we want to bring them back in as we start to break ground on building new homes from home ownership. This is why we have programs like my Buy Back the Block program that take renters in Baltimore who sometimes are paying $1,400, $1,500 a month in rent and allow them to be homeowners for $900, $1,000. We have to do it the responsible way, block by block, neighborhood by neighborhood, so that we're protecting our legacy homeowners, also taking those who are folks who are renting, allowing them to be homeowners in that neighborhood, and then inviting new people in as well.
What's the conversation you've been having with businesses, attracting more businesses who in theory are going to bring more jobs? That, of course, leads to the population growth. In fact, I think it was last year you guys had your first increase in population in decades. But when I look at some of the big employers, obviously Johns Hopkins, which we mentioned, I think Under Armour, T. Rowe Price, a few others as well. Are there efforts to try to bring in other large companies into the city?
Well, yes, and it's not just about the large companies either. It's also about the smaller and the medium-sized companies and keeping companies here. When you think about Hopkins, when you think about University of Maryland, when you think about Morgan, you should think about all the tech businesses that are growing out of those institutions, and we want them to stay here. That is a big investment in the city and things that we're going to be focused on. Obviously, as we see in the area around Under Armour that's known as Baltimore Peninsula, where you see organizations like CFG Bank that were located in Baltimore County now being in Baltimore City, when you see all the housing that's being built around there and being sold, we know that people want to be in Baltimore. Creating that environment for them to work, live, learn, earn, and play there is our responsibility. And obviously, as the mayor, spending time in New York as I was yesterday and everywhere else to let folks know that Baltimore is open for business. We are doing things in the safety realm that folks thought was impossible in our city. We have a great culture scene, authentic, and you will not find better food, especially seafood, anywhere else in the world. Where else would they want to be?
All right, I might have to debate you on that maybe on another show. Final question, though, for you, Mr. Mayor, and this really has to do with New York City. In about 3 weeks' time, we're going to have a new mayor in New York City. I think there are a lot of people who are very hopeful, but of course a lot of people who are very concerned about some of the policies that he has proposed to address things like affordability and gentrification, all the things that you've had 5 years now to address. What advice would you give Zohran Mamdani about how to navigate the complexities of running a major city?
Well, listen, I won't tell you anything that I didn't tell the mayor-elect directly. First and foremost, do what's always right and not what's popular, even if what's right is not what's best for you politically. And then also make sure that you're leading with people, building the best team, Obviously, he's going to be responsible, but I told him he has to build the best team and people that he can trust. But doing the right thing over the popular one will ultimately allow him to lay his head at night and know he did what's best for New York, but also that he will be able to live with himself, which is ultimately the most important thing.
Brandon Scott, the mayor of the city of Baltimore, had a chance to catch up with him. And of course, at the end there, giving some advice to incoming New York Mayor Zohran Mamdani. Meanwhile, we do want to go back to some of the earnings. We are getting earnings out of RH, the furniture retailer. That is just crossing the wire. They did beat on the top and bottom line, but providing some guidance for the full fiscal year that's coming in just a little bit light. For the third quarter, the quarter that just passed here, the company said net revenue came in at about $883.8 million. That's roughly in line with estimates. Adjusted EPS did fall a little bit short at $1.71. The company says that for the full year, expect revenue increases of 9 to 9.2%. Its previous range was 9 to 11%, so effectively guiding towards the bottom end of that previous range. The company also saying that for the fourth quarter specifically, expect revenue in the 7 to 8% range. The average of analyst estimates, at least as surveyed by Bloomberg, was just a tad higher than that. Nevertheless, you see the shares up about 2% here, and I do encourage, as always, everyone to go out and read the shareholder letter by RH. As usual, they do not hold back. They do not pull punches. A lot of conversations here about the state of the consumer, the state of tariffs, and how that company will be navigating it. RH shares up about 2% here in the after hours trade. Lululemon still getting a pretty strong bid as well. That, of course, has a lot more to do with the big bump from the change in the guard when it comes to the CEO. All right, and we push ahead here to some other things to keep an eye on over the next 24 hours. That includes some Fed speak. It includes, of course, a lot going on overseas in France, in Germany, and in Spain. A read on the economy over there. We'll be back tomorrow with all of your full market action right here on The Close, right here on Bloomberg.